Want to buy a dividend growth stock that seems to offer it all? Like value, yield, growth, and quality all wrapped up into one package? Looking for an under-the-radar stock that's gotten beaten up and looks cheap? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a major North American financial institution. Large financial companies are practically money machines. It's distance to source. The closer you are to money itself, the closer you are to making money. And this company has been doing just that for more than a century. Plus, it offers a compelling total package that includes a large growing dividend. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Toronto Dominion Bank, which appear to be trading at a significant discount today. Toronto Dominion Bank, stock ticker TD, is a Canada-based multinational banking and financial services corporation. Founded in 1855, Toronto Dominion, commonly known as TD, is now a $110 billion financial gargantuan that employs 100,000 people. TD reports results across 5 business segments. Canadian personal and commercial banking, 34% of fiscal year 2022 revenue, U.S. retail, 25%, wealth management and insurance, 22%, wholesale banking, 10%, and corporate, 9%. One of the 2 largest Canadian banks, TD has branched out into the U.S. in a major way and now has the most U.S. branches out of all Canadian banks. The banking business model is as enduring as it is powerful. It's a business model that dates back to antiquity. It's been around since our species gathered into societies. Since the flow of money, goods, and services all depend on banking, modern-day capitalism has served to catapult banking into the next echelon. As impressive as the endurance is, the power of the business model might be even more impressive. That power stems from the float, the low-cost and low-risk source of capital that accrues to a bank through sticky deposits. The float allows a bank to fund loans and other ventures in order to earn a return. It's essentially earning money from other people's money, which is the best possible way to earn money. If all that weren't good enough already, TD takes all this and supercharges it by way of a home market advantage. That's because TD is based in Canada. Canada has a very concentrated banking industry that is dominated by 5 very large banks. TD is part of the quote-unquote Big 5. Running a bank can be quite lucrative. Running a bank within a countrywide oligopoly can be especially lucrative. This is all added up to TD being able to routinely grow its revenue, profit, and dividend. Indeed, TD has increased its dividend for 9 consecutive years. However, this short track record belies the bank's rich dividend history. TD, as it exists today, has been formed through a series of mergers which clouds things, but we can trace a steady dividend payment back to more than 160 years ago. That's phenomenal. The 5-year dividend growth rate of 8.7% is solid in and of itself, but it's the stock's market-beating yield of 4.6% that makes this a compelling yield yield and growth package. This is a rare situation where you get both a high yield and a high dividend growth rate. That yield, by the way, is 70 basis points higher than its own 5-year average. Making matters better, the 46.4% payout ratio provides plenty of headroom for more sizable dividend raises in the years ahead. I really don't see anything to dislike here when it comes to the dividend. Looking at business growth, TD increases revenue from $27.3 billion Canadian in fiscal year 2013 to $49 billion Canadian in fiscal year 2022. That's a compound annual growth rate of 6.7%. Really good top line growth here. Meantime, earnings per share grew from $3.46 Canadian to $9.47 Canadian, which is a compound annual growth rate of 11.8%. Terrific. And what's perhaps even more terrific is the way in which the growth was consistently sustained. The last decade was just a steady march higher for TD's revenue and EPS. A general improvement in profitability across the board helped to drive a lot of the excess bottom line growth. Now, a lot of banks have been challenged around growth over the last decade. That's not surprising. From low interest rates to a global pandemic, it's been a really tough period for banks. But TD has put up some of the best numbers I've yet seen compared to the other banks that I've reviewed. Looking forward, CFRA is projecting that TD will compound its earnings per share at an annual rate of 6% over the next 3 years. CFRA sees, and I quote, elevated interest rates leading to improved net interest income, unquote. Of course, it's a bonanza right now compared to what banks have been dealing with over most of the last 10 years. However, CFRA balances this favorable rate environment against, and I quote, weakness in underwriting and advisory fees given a soft economy, unquote. There are a few other things that TD has to juggle. First, acquisitions. TD recently acquired US-based advisory firm Cowen Inc. for $1.3 billion. Cowen should accentuate TD Securities, which is TD's investment bank arm. There's also the still pending acquisition of First Horizon Corp, stock ticker FHN, for $13.4 billion, which is an acquisition that has faced significant regulatory scrutiny and may also be due for a markdown in pricing. In addition, TE owns approximately 12% of Charles Schwab Corporation, stock ticker SCHW, a stake worth about $11.5 billion all by itself. One of the biggest question marks regarding TD might be the Canadian housing market, which has looked overinflated for quite a while now. CFRA notes the, quote, potential severe downturn in the Canadian housing market, unquote, as a key risk facing TD. Seeing as how Canadian banking is only about 1/3 of the business though, I'm less leery about this issue compared to some of TD's peers. I'm willing to take CFRA's forecast as the base case that would easily set up TD for similar or even better dividend growth over the foreseeable future. And you're already starting off with a 4.6% yield. I'm having trouble locating anything problematic about that. Moving over to the balance sheet, the financial position is sound. Total assets of $1.9 trillion Canadian line up well against $1.8 trillion Canadian in total liabilities. The company's senior debt has the following credit ratings: A1 Moody's, A S&P, AA- Fitch. These ratings are well into investment grade territory. Profitability for the bank is quite robust over the last 5 years. The firm has average annual net margin of 29.9% and annual return on equity of 15%. Net interest margin came in at 1.7% last fiscal year. This is a very solid financial institution right across the board, and with economies of scale, sticky deposits, switching costs, established relationships, and an entrenched float, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. Recent idiosyncratic bank failures in the US may present additional regulatory hurdles in the near future for TD. On the other hand, bank failures and possible consolidation across the industry reduces some of the competitive pressure. As we've recently been reminded of, any bank is susceptible to a sudden bank run. If a recession transpires, this can negatively affect a bank twice over, reduce deposits and loan demand, harm the income statement, while higher credit losses harm the balance sheet. Interest rates have been persistently low over the last decade, which has constrained banks, but rates are finally on the rise. The Canadian housing market may be in a bubble, and any deflating of this market would impact TD. TD has been acquisitive, which adds integration and execution risks, and the cost of these acquisitions will have to be justified through future results. I see most of these risks as fairly standard for a large bank, and TD's well-managed history assuages most of my concerns. Furthermore, the stock's recent 20% drop has created what appears to be a very favorable valuation. The stock is trading hands for a PE ratio of 10.1. That's very low in both absolute and relative terms. For perspective, the stock's 5-year average PE ratio is 11.6. Another way to look at it is through the price to book lens. Most large banks command dividend PB ratios of between 1 and 2, depending on the bank's quality. TD has averaged a price-to-book ratio of 1.7 over the last 5 years. It's currently sitting at 1.5. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 6.5%. This dividend growth rate is at the low end of the range I'm usually allowing for. On the other hand, I tend to not get super aggressive when valuing a bank. There are just so many moving parts and the economic sensitivity is very high. I always like to err on the side of caution, but that's doubly so with a bank. However, TD has blown the doors off of this number when looking at proven earnings per share and dividend growth over the last decade. Also, CFRE's near-term earnings per share growth projection is right in this neighborhood. It's quite possible that TD exceeds my expectation here, but I also believe I'm being judicious and rightfully cautious. The dividend discount model analysis gives me a fair value of $86.72. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates TD as a 4-star stock with a fair value estimate of $72. CFRE rates TD as a 3-star hold with a 12-month target price of $67. I came out on the high end this time around in spite of what I feel was actually a conservative valuation. Averaging the three numbers out gives us a final valuation of $75.24, which would indicate the stock is possibly 17% undervalued. Here's the bottom line, guys. Toronto Dominion Bank is a high-quality, diversified financial institution that is protected by an entrenched oligopoly in its home market, with a market-smashing yield, a high single-digit dividend growth rate, a low payout ratio, nearly 10 consecutive years of dividend increases, and the potential that shares are 17% undervalued. Long-term dividend growth investors looking to take advantage of the recent fears around banks could have a fantastic opportunity on their hands here. And now for a special news announcement. Travelers Companies Inc., stock ticker TRV, just did it again. The company reported a stellar Q1 report that beat on both the top line and bottom line, with revenue coming up 10.5% year over year. Also, a new $5 billion buyback program was approved. That's more than 10% of the company's entire market cap. If all that weren't good enough already, the dividend also got boosted by 7.5%. We last highlighted this great insurance business in early 2022, and the stock is up nicely since that video went live, but it remains a blue chip company operating at a high level. Don't forget about this one. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.